still going to deal with. And those topics are consolidations, foreign exchange, and cash flow. So the last three topics that we're going to go through as well this semester is consolidation, cash flow statement, as well as foreign exchange. So the last topic that we dealt with was change in accounting policy. We're done with that. Now we're moving on to the new topic, borrowing cost. And as I've indicated before, the assessment or the test that you're going to write is going to cover change in accounting policy as well as borrowing cost. We'll let you know in time when you're going to write the assessment, but I guess you can see that once we're done with borrowing cost, then the test will be ready. So I will encourage you to practice, to go through the examples, to go through the videos that are there on my tutor, as well as the question banks. I was just checking my tutor this morning. I know that the videos for borrowing cost are already available there, as well as the question bank that we're going to use for borrowing cost. It's available. I've also sent the question bank together with a link via the class rep. However, if you haven't received it, you can go to my tutor. You'll still be able to access the question bank. You will realize that in the question bank that is there on my tutor for borrowing cost, it has 7 examples. 7 examples. However, example number 6 until example number 7, we have already covered that because it is borrowing cost related to change in accounting policy. So in other words, the integration between change in accounting policy and borrowing cost it's shown in those examples, example number 6 and example number 7. So from now on until we finish this topic, we'll put more emphasis in example 1 until example 5. However, I'm not saying example 6 and example number 7 is not important. I'm just stating that we've already covered that. If time permits us, then we'll go and look at those principles once again regarding the change in accounting policy, but relating to borrowing cost. That's where there's an integration between change in accounting policy topic as well as borrowing cost. If you have any question during this class, you are more than welcome to type it on the chat. Or if you want me to repeat anything, you are more than welcome to use the chat. So today, what we're going to do, we're going to go through the principles of borrowing cost and deal with example number 1. And if time permits us, we'll also look at example number 2. Why am I saying that? Is because example 1 and example 2, they are similar. Same information, just using different principles. So if time permits us, we'll look at example number 1 and example number 2. If it doesn't happen like that, then we'll just do example number 1, and in the next class or classes, then we'll focus on example number 2. All right. I've just shared the screen there regarding the borrowing cost. As I've indicated, I hope everyone can see what I've shared. I hope that is just the cover, Financial Accounting 3B, borrowing cost, which is International Accounting Standard number 23. So we're gonna go through the principles first, and then later on we'll look at the class exercise or example number 1 and see as to how can we apply those principles to the actual exercise. So I hope everyone can see. If you can see, please You can type on the chat there. I'll close it and open it again. I'm recording this session. After the class, I'm going to send the link for this session or for this class. If the slides are also required, I'll also send it via the class rep, because the slides are more or less the same as the question bank, even though on the slides, when it comes to calculation, you will see as we go by, I try to go as detailed as possible so that we can break down those calculations so that they can make much sense. All right, let's start. Borrowing cost is International Accounting Standard number 23. Now the question is, why did the accounting board decided just to have a standard for borrowing cost? We'll find out in the next slides. But before we do that, so at the end, what is it that is expected from you guys? What is that is expected for you to know when it comes to this topic? At this level, you should be able to calculate the amount of interest to be capitalized. Secondly, you will be expected to disclose PPE note. I love this because in semester number 1, we dealt with PPE. So by now, I believe most of you or all of you, you know how does the PPE note looks like. Now we'll be looking at the point of borrowing costs. When we have borrowing cost, how does it affect PPE? How does it affect PPE? Then you should be able to prepare and disclose finance charges note. Lastly, you'll be expected to know how to prepare the journal entries. So journal entries, the way I look at them, it's like a accounting equation. So just to give you an example is, if a company goes and buy inventory using cash, and they ask you to say, process this transaction using the journals, definitely you're going to debit your inventory and you're going to credit bank. Journals are easiest bet. So the same information, you can go and use it in accounting equation, because you know that inventory is an asset and bank is an asset. It's just a positive and negative. So whenever they ask you the journals, make sure that you get them right. They are easy journals. What do I mean by that? They're journals where you just read information and you process the journals. And there are those journals that requires the calculations, which will need you to do some calculations before you can pass the journal. But if you know the journal's legs, it becomes easier. All right, let's look at borrowing cost now, the principles. The standard is not that big, but we summarized what is relevant at this level. We summarized what is relevant to this level. As I've indicated, borrowing cost is International Accounting Standard number 23, and the standard requires borrowing cost incurred to finance construction of qualifying assets to be capitalized. So normally what will happen is, if a company wants to build a mall, for example, normally you find that most companies, they don't have that cash to build such big projects. They will go and borrow money from financial institutions. That could be a bank or any lender who can give them the money. So when they borrowed money, they're going to be charged interest. Another example that I can use is Eskom. You know, Eskom is a state-owned company. So in order for them to build those plants, those energy plants there, like Medupi and everything, they didn't have money. they had to go and borrow money from the lenders, and they came and built those power stations. So in terms of accounting standard, it says Eskom can capitalize the interest charged on those money that they borrowed. That's all about borrowing cost. So the issue with regard to borrowing cost is, will the cost incurred capitalized or expensed? The standard tells us at which stage you can capitalize, at which stage you must expense. That is very important. So whenever we're reading the question, you need to determine how much was borrowed and how much is the interest on that part. In other words, interest paid, and how much is the interest received on the money borrowed. And then we need to determine how much interest needs to be capitalized to that asset. So I can assure you that each and every example that you're going to read, they will tell you why are they borrowing money, what is it they want to construct, is it a mall, is it a stadium? Then the standard give us guidance as to at which point they can capitalize those cost charge relating to borrowing cost, at which point they must expense it. So by just reading what the standard requires, we can just look at what is borrowing cost exactly. So borrowing cost is the interest and other cost that the entity incurs in connection with the borrowing of funds. So once they borrow the funds and they charge interest or any other costs related to that fund that they borrowed, then that cost is called borrowing cost. I guess the name and borrowing cost on its own itself, even if you haven't looked at the definition, you will have an idea that it relates to the cost of funds that have been borrowed. Then it further states that when we have those borrowing costs, then we must capitalize it if the asset that we are constructing is a qualifying asset. So an asset that is qualifying is an asset that will take a long time to prepare. For example, if you want to build a stadium, it's not an overnight thing. You can't build a stadium by 1 month, for example, or less than a month. It might take a year, 2 years, 9 months, 10 months, it depends. But once it takes that long, then it becomes a qualifying asset. So just to recap here, the standard requires us that borrowing cost incurred to finance the construction of a qualifying asset must be capitalized. I spoke about it, that the key issue here when it comes to borrowing cost is which cost can be capitalized. Now they're telling us that if it relates to a qualifying asset and those costs are from the funds that have been borrowed, then they must be capitalized. All right, moving along, qualifying assets, which we just explained that is those projects that takes long to complete, can be financed either by using specific borrowings or general borrowings. I've highlighted specific borrowings and right because that is the focus of us today. We'll be looking at specific borrowings. But whenever you receive a question, when you read the question, you need to determine which borrowings are we using. Is it a specific borrowing or general borrowings? So what is the difference between the two, between the specific borrowings and general borrowings? Specific borrowings is those kind of funds that we borrow specifically for that project. For an example, if we want to build a soccer stadium and we determine that we need 2 billion, for argument's sake, and we go and borrow that 2 billion specifically to use it to build the stadium, and then it will be classified as specific borrowings. or loan. But when it comes to general borrowings, this one, as the word states general, it means that it's not specifically for the project only. That means that we might have 2 billion and we decide to use 1 billion for the stadium and 1 billion for others. So the money, when those funds, we obtain them, we don't specify as to what is that we're going to use it for. And it becomes very important because the way you calculate interest or borrowing cost to be capitalized using specific borrowings and general borrowings, it differs. You will see when we deal with the actual examples. It differs. Today, as I've indicated, we're going to look at specific borrowings. And then later on, which I presume will be Wednesday, we'll be looking at general borrowings. If you look at class example 1 and 2, it's talking about specific borrowings. Example number 3 to example number 4 is talking about general borrowings. So you will be expected to know both finance methods and how to treat it in terms of borrowing cost. All right, let's proceed. Now the question is, when can company start capitalizing the borrowing cost? And secondly, when can the company cease to capitalize borrowing cost? So the standard stipulates clearly that once the company meets all of the following criteria, then they can start capitalizing the borrowing cost. And the criteria are when borrowing costs are being incurred. That's number 1. That's the first criteria. Criteria number 2, when expenditure is being incurred by the entity in preparing the assets. And lastly, when activities are underway to prepare the assets for its intended use or sale. Then the last part is, when can the company cease the capitalization? So once the asset is ready for its intended use or sale, then the company must cease the capitalization. So what does this mean? It means that if we go and borrow 2 billion, as I've explained, and we start with our project and we meet the 3 criteria above, we can start capitalization. But the moment that property is ready for use or for sale, in other words, if we're building a stadium, the stadium is ready to be used, they can come and do all the activities that are in the stadium, then they must cease the capitalization. And we can see this is when now we'll start depreciating the asset. It's now when we'll start depreciating the asset. All right, let's proceed. We almost at the end of our principles, looking at the principles, and later on, all those principles, we must be able to see them when we do an actual exercise or example. Specific loan. So as I've indicated, that the funds received will either be specifically for the project or it will be general loan received or borrowings. So the standard stipulates that in order for us to calculate the borrowing cost to be capitalized, then we need the borrowing cost actually incurred less interest received. What does this mean? So it means that when we receive money, because when you receive 2 billion, you're not going to use it immediately. In other words, you're not going to expense it immediately. You might find out that in month number 1, you're only using 100 million, for an example. So if you use only 100 million, that means that you're still left with 1.9 billion. You can take that money and reinvest it. You can take that money and reinvest it. when you reinvest that money, you're going to receive interest. So in order for you to calculate borrowing cost, you need to get the borrowing cost actually incurred less the interest received. So it's going to give you the borrowing cost to be capitalized. This is when it relates to specific loan. This is when it relates to specific loan. So all that we're going to do when it comes to the specific loan and borrowing cost will be required to calculate, to use this formula to calculate the borrowing cost to be capitalized. We'll see in the example, which I believe is in the next slide, the whole thing about the specific loan. This is what will be required to calculate. So if you understand what we're doing here and how do we determine the amount to be capitalized, then you are halfway in terms of solving the problem, because all other transactions, you know how to deal with them. All right. Moving along. So whenever you're reading a question and they tell you that you're dealing with specific loan, you need to determine as to how are the expenses incurred. Is it evenly incurred or actually incurred? So this information will be provided to you. Before I proceed, I see there's a question here. Someone states that what does cessation mean? So that means now you need to stop capitalization. Now you need to stop. And thank you for the response there. So cessation means that now you need to stop what you were doing. So if you start capitalizing, the moment the asset is ready, you must stop capitalizing. You can't take the cost or the interest that is coming and you capitalize it. It's not allowed now by International Accounting Standard. So what does that mean? If you haven't repaid the loan, then you need to expense it. It will go to profit and loss. It's not only going to go to PPE. That's what it means. Thank you for that question. Then let's come back here. I was still indicating that when you receive a question, specifically when say specific loans, you must be more interested as to how are the expenses incurred? Is it evenly or actually incurred? So this information will be provided to us. This information will be provided to us because to have an impact on how we calculate the borrowing cost incurred. You will see in the next example, example 1 and example 2. I know example 1 is dealing with the evenly incurred and example 2 is dealing with the actual incurred. All right. Example 1, this example is the same example that you have on the question bank. As the norm, as we do in our class, we normally start on the required, then we'll go back to the exercise or the example itself and look at the information provided. In this example 1, we are required to calculate the amount of interest to be capitalized. Required number 2, we are required to disclose the following note: finance charges and PPE. Lastly, we are required to prepare the journals. All right, so we've seen the required. They want us to calculate interest to be capitalized. We'll do that. They want us to disclose the notes to the financial statement, finance charges, and PPE. I expect you guys to excel when it comes to PPE. We've done PPE as a topic on its own. The same principles apply. Then lastly, the journals. I've indicated that the journals, if we apply normal accounting that we know, whether from level 1 up to so far, if they say process the journals, you can get 60% of the marks by just looking at the information and applying the information before you even calculate the difficult part or the complex part. All right, let's look at the information. You see class example here, and we indicated that specific borrowings when expenses are evenly incurred. So when you receive the actual exercise on your assessment or on the final assessment, we won't tell you this. This information, you should be able to pick it up from the question itself. So we'll read the question as we go along, then I will tell you how do we see that the expenses have evenly incurred. We can see it by the expenses. So let's look at the information. So we're given the information of Disc Limited, and Disc Limited started with the construction of a soccer stadium on 1st January 2010. Remember, I spoke about the projects that normally it will be those huge projects that will take time. All right, the details of the project are as follows. Total estimated cost 15 million. So that stadium that they're constructing is going to cost 15 million. Expected date of completion 31st December 2012. So you can agree with me that they started the construction in 2010 and they expect to finish in 2012. Then definitely it's going to take long, and it's starting to meet those some of the criteria of qualifying assets. Someone saying we can't see the information that you are reading from. Can the other guy see the information that I'm reading from? If you can't see the information, you can use the question bank that I've sent this morning. You can use the question bank that is on my Twitter as well. Someone is thinking that we can see. Please, the one who can't see where I'm reading from, please maybe log out and log in again. Maybe you'll be able to see it. All right. So I was still explaining here that you can see that they've started this project in 2010 and they're expecting that it will be completed in 2012, which is almost 3 years, 2010, 2011, 2012, 3 years. So it's a long project, as we indicated, and it can qualify as a qualifying asset based on the definition of qualifying asset. And here they said the following expenses were incurred during the year ended 31st December 2010, and I've highlighted it in red for a purpose. Why am I saying that? Because if you look at these expenses, the way they're incurring, you see from 1st January 2010 to March 2010 at the end. So they incurred 1.6. Again, April to June 2010, 1.2. July to September, 1.4. October to December, 1.7. Right. So if I look here at how these expenses are being incurred, I can tell you that they're being incurred evenly on a quarterly basis. So each and every quarter, which is 3 months, they're incurring the expenses. So we don't look at the amount, we look at how these expenses have been incurred. So remember, I've indicated that you need to get as to, are you dealing with the actual expenses incurred, or how the expenses are this company is incurring the expenses. Here they're incurring these expenses on a quarterly basis. They can even incur expenses on a monthly basis or 2 monthly basis. The information will be given to you. But in this case, we can all agree that these expenses are incurred evenly on a quarterly basis. Quarter 1, January to March 2010, quarter 2, April to June 2010, quarter 3, July to September 2010, and the last quarter because the year end is 31st December, it's October to December 2010. But bear in mind that this project there is being expected to be completed in 2012. All right. The last part of the question, the say on 1st January, Disc Limited obtain a specific loan. This is what I was referring to. They will tell you what type of loan you're getting. So they are receiving this loan specifically for this project. So let me finish reading. On 1st January 2010, Disc Limited obtained a specific loan to the value of 10 million to finance the construction of the soccer stadium. So this loan has been obtained specifically to construct the stadium. So you will see when we go to the example as to how do you differentiate between the specific, but the specific one is clear. We required this loan of 10 million and we obtained it on the 1st of January 2010 specifically to finance the soccer stadium. Interest on specific loan is charged at 10% per annum. The loan will be repaid in full in 2012. Just this paragraph is very important because now it's telling us what type of loan did we receive. We received a specific loan because it's specifically for the stadium. When did we receive it? On 1st January 2010. And the interest will be charged at 10% per annum. And the loan will be repaid in full in 2012. Then the next paragraph states to us that interest capitalization is capitalized or compounded annually. Interest could be capitalized or compounded quarterly as well as monthly. So it is very important that you read the information properly because it will have an impact on your calculation. Annually, this is the easiest one. We're just dealing with the annually part of it. Quarterly, we'll see if we have an example similar to this, as well as the monthly. So, but we just want you to be aware so that now when you go to the assessment, they give you monthly, you go and apply annually, and then you're not going to get the calculation correct. However, surplus funds are invested at 5% per annum and will be deposited in the nominal trading account of the company. This is very interesting. As I've indicated, we borrowed 10 million. We're not going to use it at once. So any amount that is remaining, we're going to invest it and we'll receive 5% interest income on it. And the directors of Disc Limited have decided to adopt a policy to capitalize interest on qualifying assets. The soccer stadium is a qualifying asset. Now they're telling us, we could have seen it from the information above that this soccer stadium is more likely to qualify as a qualifying asset. Why? Because it's going to take long to construct. All right, so here's the information provided. We back at the required. And required number one, they want us to calculate the interest to be capitalized, which is all about the borrowing cost. And after that, they want us to disclose the interest that we capitalized and reflect it on the finance charges as well as the PPE. Lastly, they want us to process the journal entries for the year ended 31st December 2010. It's very important because now we're dealing only with transaction from 1st of January 2010 until 31st December 2010. That is the timeline we're dealing with. That is the timeline we're dealing with. So here's the information. We read about the information. I told you that borrowing cost is all about as to how much we're going to capitalize on the funds that we received. And in this case, it's a specific loan, and we have determined that the expenses were incurred evenly. Hence the example here stipulates that, and I've indicated that in an assessment or in any assessment or in a test or in exam, you won't be given this. You'll be able to determine it, as I've explained here. All right, so now these are the three requires. How am I going to start with? I'm going to start with the journals. Journals are the easiest one. As I've indicated, whenever you ask a question to process the journals, I can tell you that you can get 60% of the marks of the journals without even sweating and doing maths, as long as you read the information and you apply it. So let's go and see how to deal with that. I'll deal with the journals. As we process the journals, we'll also be able to respond to required number 2 and required number 1. So just to get the summary of what we got on the information that this is not necessary, it's just for us to do the recap. I know when you're writing the final exam, you want to have the liberty to do the summary. You want to have the liberty to do the summary due to time constraints. So we have a specific loan specifically for the soccer stadium. They told us that the soccer stadium is a qualifying asset and the expenses were incurred evenly throughout the quarter. I've explained about that. Our financial year end, 31st December 2010. Loan obtained on 1st January 2010 at 10% per annum. Surplus funds invested 5% per annum. There's more information. This is just the summary. Now, let's look at this. If you look at the question bank that you've been given, which we have already spoke about it, in order for you to calculate the interest to be capitalized using specific loan and the expenses have incurred evenly. So you need the borrowing cost actually incurred, and then you less the average surplus. We'll explain this in calculation in detail. Then you have your interest capitalized. The formula looks easy from face value, but there's more work to do that is required. You need the borrowing cost actually incurred during the period less the average surplus, then you have the borrowing cost capitalized. So whatever you see here, it is what is required in required number 1. So we'll do the calculation and say that, but we're not going to start with that. We're going to start with the easy part. Okay, let's start with the easy part. Loan amount. So on 1st January 2010, we received 10 million. We can all agree with that. We received 10 million. Remember, we're processing the books from 1st January 2010 until 31st December 2010. So if the company has received 10 million, that means their bank has increased by 10 million and their loan has increased by 10 million. Here's the journal. So on the journals that you're expected to process, this is the first journal I expect to see on 1st January 2010. Hence, I was explaining that when it comes to the journals, you can get 60% of them without doing the hard work. Debit bank, credit loan, you receive 10 million. When? On 1st January 2010. We will see this when we go to the solution. This should be your first journal processed. So in other words, you are responding to the required number 3. All right, so let's proceed now. Interest paid, right? Interest paid. So we were told that our interest is going to be 10% per annum. And the loan amount is 10 million, right? So if you go at the end of December 2010, we haven't repaid any part of this loan. If you look at the information, we haven't repaid any part. So in order for us to calculate the interest, it's 10 million multiplied by 10%, multiplied by 12, divided by 12. Why is that important? It's important because it's from January to December. It should be 12 out of 12, because if we receive loan in April, then it's going to be 9 out of 12. The month, the interest. So this is the interest paid, which is 1 million come at the end of December. We are expected to pay the amount of 1 million. So we're going to credit bank and we're going to debit interest expense to the value of 1 million, and the general narration interest paid for the year. That is the journal you must expect to see when you go to the journals. That's what I'm saying. if we apply the information that we have without doing the complex calculations, the general part will deal with it in the easiest way. So now, maybe the question is, what about if there was a repayment? So if there was a repayment, we only look at, say, 10 million, the loan was received, less the repayment. Let's say the repayment was 1 million. So it was going to give us the balance of the loan that we owe as 9 million, and we multiply it and we get the amount of the interest that we expected to pay at the end. I hope we're still together so far. I hope we're still together so far. So far, so good. That's why I'm saying in each and every question, there's always easy marks. Now, let's go and look here. We're given the expenses, say construction expenses incurred. This is in the table on the required there. I just took it as it is. From 1st January 2010 to 31st March 2010, 1.6. It's like quarter 1, 1.6. Quarter 2, 1.2. Quarter 3, 1.4. And the last quarter of the year we're talking about, which is 2010, 1.7. If you add all those expenses, it's going to give you 5.9 million. It's going to give you 5.9 million. Now let's talk about the journal now. So as you spend this amount, then you're taking it from a bank, 5.9 million, and you're recognizing your asset, which is a soccer stadium, and the soccer stadium is classified as plant here, and the corresponding account you will be debiting plant. Why? What is it for? Construction expenses incurred. That's all you do. So this is journal number 3, which I expect to see on the journals. This is journal number 3, which I expect to see on the journal. So you will agree with me if I come back here, as I've indicated. Journal number 1 was not that complex. Journal number 2, also not that complex. And journal number 3, not that complex. Now the issue we need to deal with the last journal. What this topic is all about, calculating the interest to be capitalized. That's all about. But what I'm trying to show you, I know most of the students I see when I mark these type of questions, you'll find out because we have 3 required, like in this case, interest to be capitalized, disclosure, and the last part, you'll find out that students normally the last part of the required, they don't respond it. But what I'm trying to check here is develop a technique and see where do you start? Like I indicated to you, I'm going to start with the journals. I've dealt with almost 60% or 80% of the journals. The only journal that is remaining is for the interest to be capitalized that we need to process. And in order to do that, we need to do the calculations first, applying the principles. That's all. But receiving the money, that is the journal I expect everyone to get it right. Interest on the money that we owing, and we just spoke about now the expenses incurred, because these expenses are incurred in order to construct the stadium, then definitely will be capitalized against the asset. All right, so now let's go to the last part, which is dealing with borrowing cost to be capitalized. I will start here with that. Here's the formula. This is the formula we're going to apply. In order for us to get the interest to be capitalized, which is also what is required in required number 1. Here, calculate the amount to be capitalized. In order for us to do that, we're going to use this formula. So the formula is telling us that you must get your borrowing cost actually incurred during the period or during the construction period, and then you less your average surplus borrowing balances during the capitalization or the construction. We're using the average surpluses because the costs have been incurred evenly throughout the quarter. That is the reason we're using the average surplus. So we're going to spend some time dealing with how to calculate that. So let's start by calculating the interest received or the interest income. In other words, let's start by calculating this part. The first part, it's easy to calculate. Let's start by calculating this part. So if we solve this and we solve this, then we have interest to be capitalized. We just need to disclose it in our journals together on our PPA as well, and also on our finance charges note. So I want us to spend some time here. Interest received or investment income. Remember, we received 10 million. When we receive 10 million, whoever gave us that money say, I'm going to charge you interest at 10% per annum. But as the management or as the company, they decided to say any surplus fund must be invested at 5%. So in other words, we'll be receiving money. As much as we are paying, we'll also be receiving money. Let's start with the receiving part, because that is the one which is most interesting when it comes to specific loan. Interest received or investment income. First thing first, let's start here. We have quarter one, and quarter one is from January to March 2010. This is the period. Right? This is the period. And when it comes here, it's explained to us that we must use the average surplus. So we need to determine what is the average surplus. What does that mean? This is what it means. It means that if you go to January 2010 and you ask me that how much do we have as our surplus? We are having 10 million. Remember, we haven't used anything. We just receive it. We haven't received. So on 1st January 2010, we have 10 million as our surplus. And then if you go to 31st March 2010, we have 8.4 million. Where did I get this 8.4 million? It's 10 million that we had in January, less 1.6 million, which has been used. So if you go to the expenses from January to March, 1.6 was used. In other words, the remaining amount is 8.4 million. So in order to apply the average, because costs have been incurred evenly, you take the 10 million, you add it with the 8.4, it's going to give you 18,400,000. And in order to determine what is the interest received, then it's going to divide it by 2, applying the evenly, multiply by 5%, that is the percentage that we're getting, multiply by 3, divided by 12, because from January to March is 3 months, then you will get your interest income in quarter one, which is Jan to March 2010, 115,000. Let me repeat this because this is the most important part. What is key here is this is a specific loan. That's number one. Number two is the expenses also are incurring evenly throughout the quarter. That is also important. So if I look at the formula is saying to me, this is what I'm calculating, say, in order for me to calculate the interest received, I must use the average surplus on borrowing balances. So in order to determine that, it's what I was doing here. I'm saying that because we're going to use the average surpluses to say, first thing first, you must go to 1st of January 2010 to say, how much was the surplus? It was 10 million, the full amount that you received because you haven't used it. When you go to 31st March, how much is the surplus? It's 8.4 million. In other words, 8,400,000. And if you add the two, this is your surplus, is 18,400,000. Apply it evenly, multiply by 5%, multiply by 3 divided by 12 is going to give you 115,000. That is the income you're going to receive in the first quarter. Quarter 2, we're going to apply more or less the same principles. So you will agree with me, if on the 31st of March 2010, we had a surplus of 8.4 million, that will be the surplus we have on 1st April as our opening balance of 2010, 8.4 million. June, we need to take 8.4 million less 1.2, the expenses incurred during that period, and it's going to give us 7.2 million. We add the 2, 15.6 million, divided by 2, why 2? Because evenly incurred, multiply by 5%, multiply by 3, divided by 12. Now it's becoming a repetition, right? So interest received for quarter 2 is 97,500. So you will see that if when we go to the solution, they put all this information together. I just decided to break it down. So when you're writing, it doesn't matter how you write it. Do it as long as it makes sense to you, but we want to see the calculations as to how you did the calculations, whether you do it this way or you do it the way it is in the solution. It's all acceptable. All right, quarter 3, 1st July 2010, 7.2. Yes, the 7.2. That means it will be opening. Then the closing will be 7.2 less the expenses incurred, which is 1.4. Then 5.8. That's going to give us 13 million. 13 million divided by 2, multiplied by 5%, multiplied by 3, divided by 12, 81,250. Quarter 4, our opening will be 5.8, and our closing is going to be 4.1, given by 5.8 less 1.7, which are the expenses incurred. Then we have 9.9 million, and we apply evenly, multiply by 5%, multiply by 3, divided by 12. That's going to give us 61,875. Again, I must warn you, it doesn't mean, it can happen that the project is completed here. So that means you will never go to quarter 4, or it can, so in other words, it's not that always it will be 3 out of 12. You may find that the last month is 1 out of 12, depending when the project is completing. So you need to determine that. It's just that in this case, in the example that we use, it was for almost like all 4 quarters. So that's why we're using 3 out of 12. So quarter 3, 81,250. Quarter 4, 61,835. So if you add all the quarters, it should give you 355,625. So let's come to the formula. So the formula is stating that in order for us to have the borrowing cost to be capitalized, you need your borrowing cost incurred less interest received or income. The interest received, the total amount of those quarters should give you 355,625,000. Borrowing cost incurred, we can calculate easily that this is normally the interest that you paid for the full year, 1 million. We dealt with it in journal number 1. So 1 million less 355,625 is going to give us 644,375. This is the borrowing cost to be capitalized. We can pass the journal based on this. So remember, it's borrowing cost to be capitalized, and it's going to be capitalized against the what? The plant. In other words, we're going to debit plant and we're going to credit interest to be capitalized by this amount, 644,375. That's what we're going to do. So this will be our last journal. So if I quickly go to required number 3, I'll do the recap. I'll start with this amount of 644,375. Then I'll explain the other journals, which I've already did. So here's the solution. The amount that we're talking about which we're calculating about is interest to be capitalized for the year, 644,375. So we debit plant, credit interest expense with the same amount. We spoke about the interest paid for the year, 10 million. We spoke about the construction expenses, 5.9 million. We spoke about the interest paid at the end, 1 million. Here is when we receive the actual loan, not the interest paid. It's when we receive the actual loan here. So it's loan receivables, 10 million and 5.9 with regard to construction expenses. I've shown the breakdown as to how I've calculated that. The interest, 10 million. And here's the most important part that we just dealt with. Interest to be capitalized, 644,375. So required number 3 is done. Those are the journals expected. So now let's go to required number 1. Everything that I was explaining in those tables has been summarized easily here. Investment income or interest received. Remember, I was talking about the quarter. This is the first quarter. It's 115,000. You have shown the calculations here. As I've indicated, it doesn't matter whether you do it this way or the other way around, as long as it talks to you and it makes sense to you. But all in all, what is important is the total investment income is 355,625. And the borrowing cost incurred, this is the interest that has been charged, it's 1 million. The difference gives you 644,375. So now let's look at the note. Here, what is important is, before we even look at the amounts, you must know how the finance charges note look like. In order for you to calculate the finance charges note, you need the total finance charges, and then you less your borrowing cost capitalized. This amount, we just determine it. Total finance charges for the period, 1 million as well. So before you even worry about this amount, worry about knowing what to put here, what to include. Because I've seen from my experience when I'm marking, a lot of guys don't even have an idea how the note of finance charges look like. At the end, they just leave it. And when you leave it, you lose the marks. And this we've already calculated. If you go to a journals, it's going to tell you interest expense, which is the total finance charges, less borrowing cost capitalized. You just need to be aware if there's no other additional finance charges besides this one for borrowing cost. Just that in this case, it was only 1 million. But all these amounts, you can agree, they are there on the journals. PPE, as I've indicated, carrying amount at the beginning, there was nothing given in this exercise. Gross carrying amount, same applies. Accumulated depreciation, same applies. So the cost incurred, 5.9 million, we calculated about it. It's increasing the plant that we have, or the soccer stadium that we have. And what we were calculating all along, it was borrowing cost to be capitalized. This is the portion of the cost of the funds that we borrow that needs to be capitalized. In other words, it needs to be increased on the PPE. That's why we're getting 6,544,000. So don't fall into the trap where you go and you deduct the borrowing cost to be capitalized. Even if you calculate it correctly, in accounting, we're more concerned about the positive and negative. If you come and deduct it here, you're not going to get any mark. Capitalization means increasing the cost of the assets you're dealing with. So that's all about class example 1. So now we're quickly going to look at class example number 2. Let's say, what is the difference now? Because here we're looking at when expenses incurred evenly. Now let's look at example 2. Same information as it is, but now the expenses will be dealing with the actually incurred. I'm going to close this. I'm going to project the other slide. All right. Let's proceed and look at example number 2. You'll agree with me that when it comes to example number 2, now we're just talking about expenses here are actually incurred. So now what is the difference? Previously it was evenly, but now if you look at the expenses here, they're actually incurred. You can see even by the days is that now on 31st March 23rd, 30 June 23rd, previously it was say 1st January to March. Now the expenses will just say all these expenses will be incurred on 31st March 2010 and it's 1.6, June 2010, 1.2, September 2010, 1.4, and December 2010, 1.7. So how does it differ? How does it differ? So let's quickly look at the required. The required is more or less the same. But the only difference here is now the loan amount, which is specific, and the expenses, the way they are incurring. They are incurring, we're using the actually incurred as opposed to evenly incurred. And I've indicated at the beginning of this class that there's a difference on the treatment. There's a difference on the treatment when we're dealing with that. So I think what we need to do now is, I see that we'll end up being messed up with this thing. This will be our next exercise in the next class. Go and prepare example number 2. Go through it in detail and we'll go with it step by step. So today we dealt with example number 1. You can go and do a revision in example number 1. In the next class, we're going to look at example number 2 and also look at the video explaining the principle so that when we come to class by Wednesday, if you have any question, we'll be able to cover it there. So our next class, we'll be dealing with example number 2. These slides which I have here, I will also send the slides as well beforehand, before the class, together with a link. Any question regarding to example number 1 that we dealt with? So someone will say, will we always be given expenses that incurred? Yes, the expenses will always be given. The expenses will always be given. And you will also be able to see how these expenses were incurred. Is it evenly? Is it actually incurred? You will see. Today I showed you how to see the evenly incurred. In the next class, I'll show you how do we see that these expenses have actually incurred. Any question? Any question? Type there on the chat if you have a question. I will still be here. Just a reminder that the next assessment, the assessment that you're going to write, it will be 2 topics: change in accounting policy, as well as borrowing cost. But do you have any question with class example that we just did, which is example 1? You're more than welcome to type it in the chat. I'll respond to it. Next class, we'll be doing class example number 2. So where is the 5% going since we're investing? I don't get that part. Okay, thank you for that question. If you read properly on the 5%, they say the 5%, any amount that we didn't use in a particular period. Here we're talking about the quota. You must invest it to earn interest. So the 5%, let me project that class example 1. Let me project that class example 1 so that we can iron out this one. Just give me a minute. So let's look here, the required. It says surplus funds. I believe we understand what is surplus by now. Are invested at 5% per annum and will be deposited in the nominal trading account of the company. So let's look here at this formula. In order for you to determine the borrowing cost to be capitalized, you need the borrowing cost actually incurred less the average surplus borrowings balances. So in other words, this portion is the interest income. This portion is the interest that you paid. So in other words, for you to determine the borrowing cost to be capitalized, you need interest that you have paid less interest that you have received. So the 5% is here. The 10% is here of what you're paying. That's all about the borrowing capitalized. So that's why in these calculations here, we're calculating as to how much we'll be receiving using the 5% from quarter 1 until quarter number 4. And we added this quarter, these amounts, and we ended up with 355,625. In other words, for you to have borrowing cost to be capitalized, you must take your borrowing cost incurred less interest received when you're using this specific loan. That's why that's why the 5% is going. I hope you are answered. Thank you for that question. Any other question? Any other question? I'm still saying it again. In our next class, go prepare example number 2. It's a still specific loan borrowing cost, but now the expenses have actually incurred so that we can see the difference. If you come prepared, it won't take us long to finish that exercise, and it also assists that you come with the questions. If you have any questions, then we'll respond to them during the class. Any question? I'm still here regarding example number 1, borrowing cost. If there's no further questions, then that is going to conclude our class. The recordings together with the slides will be sent via the class rep, and I urge you guys to go and look at the video uploaded just to brush up the principles so that you understand these principles at the end of the day. And thank you very much for coming to the class. See you in the next class, which is Wednesday.